Assalamu alaikum class. In this lecture, we will learn how to record transactions that are related with the issuance of common stock as well as preferred stock. Whether whether the stocks are issued against cash or against any other assets. And we will also focus on recording of dividends, and then we will prepare a stockholder equity section. So here we have a comprehensive problem 11.4a from the book William Dhaka Bettner, Financial and Managerial Accounting, which is also known as Meigs and Meigs Accounting. So the company is formed with the name of Barnes Communication Incorporation. The corporation was authorized to issue 50,000 shares of $100 par value, 10% cumulative preferred stock, and 400,000 shares of $2 par value common stock. So these are the authorized capital. The following transactions uh, among others, occurred during the year. So these transactions are exclusively related with the shares or a stock. So on January 6th, so first transaction is related with January 6th. Issued for cash means these shares are issued against cash. 20,000 shares of common stock at $14 per share. We know that we have already discussed the par value is $2, whereas it is issued at $14. This means that the difference between two is additional paid in capital. The shares were issued to Barnes and 10 others investor. So the company got cash. So cash is on the debit side. 20,000 number of shares are issued and issued for $14 each. And then common stock is on the credit side because 20,000 shares are issued with the par value of $2. And then the remaining amount is additional paid in capital. So additional paid in capital, and here uh, total number of shares are 20,000, whereas the difference between 2 and 14 is 12. So 12 is the um, additional paid in capital. So this is the transaction related on January 6. On January 7, another entry. The company issued an additional 500 number of common stock to Barnes in exchange for his services in organizing the corporation. Means this is the initial expenses, or these are the preliminary expenses. So this can be recorded by debiting preliminary expenses or organization cost expenses against the issuance of common stock. So 500 shares were issued. The stockholders agreed that these services were worth $7,000. So this means that the organization cost or the preliminary expenses are for $7,000. So organization cost expenses, because these are expenses, so these are debited by $7,000. And then common stock, total 500 shares were issued with the par value of dollar 2, and the remaining amount is additional paid in capital. Additional paid in capital, which you can say uh, we will deduct 1,000 from $7,000. So the 6,000 represent additional paid in capital. And we have Next entry is on January 12th. So issued 2,500 shares of preferred stock for cash of $250,000. So this means that these shares are issued at par because the par value is $100. So the company got cash. So cash is on the debit side, which is $250,000. And preferred stock were issued. These preferred stock are 10% cumulative. So 10% cumulative preferred stock were issued. The amount is same, that is 2,500 shares, and one share is $100 par value. On June 4, the company again issued some shares. Why? Because the company acquired land as a building site in exchange for 15,000 shares of common stock. Now, in this case, the company got land instead of cash. So, company purchased land by issuing 15,000 number of common stock. So, the board of directors agreed that the value of this transaction would be $15 per share. So, the company acquired land. So land will be on the debit side, and the amount is $15,000. 15,000 number of shares multiplied by $15 per share. So this is the amount of land, whereas it is purchased by issuing common stock. So 15,000 shares were issued, whereas the par value per share is $2, whereas the remaining amount is the additional paid in capital. Additional paid in capital, and there are 15,000 shares issued multiplied by the difference between 15 and 2, that is the market value, and the par value is 13. So 13 is the premium, which is $195,000. Then in the next transaction, on November 15. Next transaction is on November 15. So in this transaction, the first annual dividend of $10 per share were declared on preferred stock to be paid in December 20. Right now, the dividend is just declared, not paid. So cash is not involved in this or at this point of time. So the hint is also given, record the dividend by debiting dividend and crediting dividends payable, because at this time on November 15th, just the liability is created. So dividends is on the debit side, and this dividend is on preferred stock. So $10 per share. So how many shares? These are, you can see on January 12th, 2,500 shares were issued. So 2,500 multiplied by $10 dividend. So total 25,000 dollars dividends were announced. So this is just announced. That's why dividends payable will be on the credit side. Just liability is created. That's why dividend payable is on the credit side, $25,000. So on December 20th, paid the cash dividend, means these dividends are paid on December 20th. So we will decrease this liability, or will, so dividends payable. Now we are decreasing or eliminating this liability. So now that's why this liability is on the debit side, and cash, because we paid dividends, so cash will be recorded on the credit side, which is $25,000. Now, on December 31st, after the revenue and expenses were closed into income summary account, that account indicated a net income of 147,200. So, class, we have discussed in detail how to close the amounts we close. There are four closing entries. One is related with revenues, other is related with expenses. The third one is related to closing income summary account, and the fourth one is dividends. So, as mentioned in the transaction, that revenue and expenses were already closed. So now two closing entries are required. We have discussed in detail in chapter 4 and chapter 5 how to close the accounts that are related with income statement. So here we are just recording our closing entries, which is on December 31st. So first entry is about net income. So net income will be on, because revenue has already closed in income summary account. So now we are going to close income summary on the debit side, and income summary is closed in the retained earnings. Please refer chapter 4 and chapter 5 lectures, particularly chapter 5 lectures that are related with the closing entries. You can check it in the playlist. So the amount of profit is $147,200. So this is, then dividend is also closed. So December 31st. So retain dividends are closed in the retained earning account. So retain earnings will be on the debit side, and dividends are on the credit side, because dividends initially record on the debit side. So when we want to close it, we convert it, or we send it, or we record it on the credit side. So the dividends are total amount 25,000. So 25,000. So this is the total 25,000. So this is the total journal entries, or the most of the journal entries that are related with the stockholder equity or shares or dividends and so on. So the next requirement is to prepare stockholder equity section. So first of all, we write the name of the company, Barnes Communication, then partial balance sheet as on December 31st. Year is not given, so just now. First of all, we present stockholders equity portion. In this portion, we mention common stock. So total, how many shares were issued, common stock shares, you can see common stock shares 40,000 plus 1,000. So 41,000 and 30,000. So total common stock issued, uh, 71,000 amount. You can write it here. common stock, we can divide 71,000 by 2 because $2 is the par value. So, in order to get the total number of shares issued, so total number of shares are issued 35,500 shares at the rate $2. So you can see the calculation. 35,500 multiplied by 2. So 71,000. In this case, we have $71,000 total amount of common stock. So from this 71,000, we calculated this 35,500 number of shares by dividing 71,000 by $2. Then we have 10% preferred stock, and this preferred stock is basically cumulative preferred stock. So 2,500 number of shares were issued and at par value, so par value is $10 at the rate $10. So here 2,500 multiplied by par value. So this is the total amount of cumulative preferred stock. Then we have additional paid in capital on common stock. So additional paid in capital on common stock is total. Um, we can add additional paid in capital. We have 240,000, then 6,000, and then 195. So 240,000 plus 6,000 plus 195,000. So this is your total additional paid in capital. You can see, I can show you at all by minimizing all. You can see this. So here we have 240 and then 6,000 and then 195,000. So this is the total paid in capital. By adding all these three, we get total paid in capital. This is the additional, and then we get total paid in capital. Total paid in capital amount is $762,000. So this is total paid in capital. Now we add retained earnings. So for this, we will have to calculate retained earnings. Calculation of retained earnings. We have retained earnings opening balance. You can say at January 1, it is given here, this one. This amount is given, this is the basically net income. So we do not have any retained earning, opening earning, no. And because this is the first year of corporation, the corporation organized in this year. So we do not have any opening retained earning. So it is 0. Then we add profit in it, add net income, which is given, which we have closed in the retained earning account. You can see this is 147 and 200. So it is given. And then we also close dividends. So we will deduct dividends from the retained earnings. which is, you can see 25,000, so minus 25,000. So what will be our closing balance of retained earning? This one. So this represents closing balance of retained earning, retained earnings at December 31st, and year is not given. So this is the retained earning which we are going to add 122,200. So by adding retained earning in total paid in capital, we get total stockholder equity amount. So here we have stockholder equity. So this is the problem. In this problem, we have discussed about the journal entries that are related with the recording of common stock and preferred stock, as well as how to record journal entries if stocks are issued against cash or against any other asset or expense. So then we prepare stockholder equity section by calculating retained earning. We also discuss two type of closing entries that are exclusively related with the closing of net income into retained earning, or you can say closing of income summary into retained earning and closing of dividends into retained earning. So that's it from this lecture. Take care, class.